Hello, everyone. I am Brady Bridges, and I'm the broker and owner of Reside Real Estate here in Fort Worth, Texas. I want to welcome you to another episode of Real Talk with Reside Real Estate. We are a top producing team here in Fort Worth, Texas, and we want this podcast to be a resource for anyone looking to learn more about real estate and the great city of Fort Worth, Texas.
Welcome back to another episode of Real Talk with Reside Real Estate. Today, I'm joined by William Adams. He was one of our earlier guests when we first started doing the podcast last year, so thought it'd be good to have him back on. William's with Legacy Mutual Mortgage, and just thought this would be a good time to kind of recap what's going on kind of mid-year after our initial conversation. So, William, thanks for coming back in.
Yeah, happy to be here.
So if you want to, just because if somebody maybe didn't catch your first episode, kind of tell people a little bit about you and your team and what you guys do.
Yeah, so I'm at Legacy Mutual Mortgage. We have been doing loans here in Fort Worth and surrounding areas for 7 years now. We are right here over by TCU, right in the middle of Fort Worth, and we specialize in all residential mortgages and all types of loan products and types, but our goal is to get people into houses.
Awesome. Last time we were in, we were talking about the national championship game and the bowl games, and obviously things worked out a little bit better for you than they did for me.
I mean, you brought it up, not me. I thought about wearing red. I thought that might not go over well, but it was a great game. And, you know, only one team wins in the
I think that was before we actually had the Michigan and Ohio State games, too. So at least I got
Oh, yeah.
I got one good one in there, and I can forget about the other.
Oh, it was still a big season. So what crazy that it's going to be here before we know it. But yeah, crazy. It's been about half a year since we sat down and talked. And from a mortgage market standpoint, a lot has changed. But at the same time, we're not far off from where we were at that point when you look kind of on a macro scope of interest rates. So I'm interested, and excited to talk to you about kind of where we've gotten to at this point.
So yeah, obviously I think it was back in December when we talked about this the last time. If I remember, the rates were kind of in the mid sevens or so. So what are you seeing now we're in the middle of the year, the Fed's continued to increase interest rates a few different times up to this point. How have you seen the changes in the market and where the interest rates are today?
So I would say here, as we sit here kind of in late spring, we've seen more stability in the market than we've seen in a while. There were just super high volatile swings where I remember February 1st, it was the day we were all iced in. We locked someone at 6.00%. It was actually someone that closed with Reside. And then a month later, on March 1st, we closed someone at 7.0, or we locked someone at 7%. So you're talking about in a 30-day span, these just wild swings where it had ended the year in kind of the high, low to mid sevens. You just see it all drop all the way down to the low and even right at 6, and then, kind of roll back up. And it's been in that, 2 steps forward, 1 step back range where, truthfully, depending on the day, there would be good days and bad days that would have a sensitivity to the market where, some days may be right at 6.5, some may be at 7, maybe at 7.25, and you really couldn't predict it. And we tried our best to kind of predict the news cycle, but so many things have happened in this year as well.
Probably difficult to keep borrowers happy whenever they go and they maybe have been shopping for a month. The rates are at 6%, and then the next month they no longer qualify for what they were talking about.
Yeah, truthfully, what's really interesting about that is even though we've seen a lot of volatility in this past 6 months or first half of this year, we've now, as we're in May, rates shot up to 6.25 June of last year. So now we're saying that anyone that is in the housing market and has been for this past year, they've entered the market or they've gotten pre-approved or pre-qualified at rates that have been somewhere in the 6 to 7 range. So we're no longer really talking to people that, because if you got pre-qualified last March and you were at 3.5 or 4, and then you waited until the summer and it was at 6.5, that's a huge change. The difference between 6.5 to 7 to 6, 7.25, like there's not a groundbreaking difference in terms of when it was doubling. So I do think that while it has been volatile and it makes it a little bit tricky, we are dealing with a buyer pool. And I think that's where maybe there's been more activity lately because people have become accustomed to, or they've recalibrated their housing search. They're just more comfortable or understanding what that payment is, or at least have the information to say, okay, I'm going to buy now. And if that means that, the opportunity to refinance may come later, I kind of understand how that looks.
Well, and I think on our end, we had a lot of people pull back, and a big piece of that was the interest rate side of things. But I also think a tie to that is people thought that a lot of people would start buyer selling homes or home prices were going to drop. And it's actually been the complete opposite. You've seen some areas obviously have some decline in some of the outskirt areas of town, but some of the areas we see that are the most popular, we're back in those multiple offer situations, and people. I mean, it's one of the questions I have for you later, but the cost of waiting. You wait around hoping that something's going to happen, and it doesn't happen, and we still have extremely low inventory. So, I think the market. I don't know what you've seen. I know we've done some deals together, but I feel like things have really picked up, especially in the last 3 months. And I'm wondering, do you think that's because it's been more stable with the rates?
I think so. And I think that, we're fortunate in Tarrant County and in the surrounding area that it's just a lot of these neighborhoods are really, really strong. And time again, you see that it's not a market issue. It's purely an inventory issue because, I can count on a couple hands, a house that hits the market on a Thursday, and I'll hear from 3 different people that weekend that, maybe they don't all make offers, but they want the numbers. They want to hear it. And it's like, oh, it looks like we just got something new on the market because there's a lot of people sitting and waiting and interested. They're just waiting for something in whatever neighborhood that, maybe is one of the really competitive ones to get into. So I think to me, every time that happens, it just goes to show that we truly are in an inventory situation and a shortage, not a market issue where prices are going to go down. You could argue that in some cases they're continuing to increase.
So I know, you and I talk about investment property. I've worked with a lot of investors, you have as well, on that side of things. And last time when we were talking, I don't know if we brought this up, but the interest rates for a borrower that's trying to buy investment properties were extremely high. Are you still seeing that to be the case right now?
So I would say, I'd have to go double check, but I would venture out to say that the rates that we started 2023 with for investment properties haven't probably moved an inch since, because what has happened on those is they've essentially been capped, and the rate is capped kind of in the mid sevens, and then there's just a required buy down or discount that comes associated with it. Because in theory, if you're buying an investment property, if there's a 1-point cost or a 2-point cost just relative to kind of keeping the rates at a certain point, someone would rather just go pay 9% at no cost and refinance it 6 months, 9 months, 12 months later. And so for whatever reason, that's been a really interesting market because they're continuously, when we check it, sometimes it's, in the low to mid sevens or really right around mid seven with no buy down. But more often than not, it's been just what is the amount of buy down. And so the rate hasn't really changed. The cost of the rate is what's changed.
Yeah. I'd be really curious to see, back whenever it was really hot, like 2 years ago, a year and a half ago, if we listed anything from 270,000 to 400,000, a lot of those investors were just instant buy it up. So I guess you may not know, but are you seeing that activity increase, like on your side, for people that are investors trying to get back out there and buy, or do you see a lot of people holding off?
I've talked to a lot of investors who've had the question about doing a delayed cash out. So people that can get their hands on money other way to go buy the house in cash to still stay competitive and still stay in the market.
What is a delayed cash out?
So there's what's called a delayed financing addendum, and it allows you, there are special circumstances where if you pay in cash, you can then immediately do a cash out. But for investment properties, typically that isn't the case. That doesn't fall in the category. So you have to hold on to it. It used to be 6 months. They just adjusted it to 12 months. So in theory, you buy a house in cash, hold on to it for 12 months, and then you're able to take out 75, 80% of that cash, which right now, truthfully, if there's that amount of, cash available or dry powder to go do that, you're probably looking at a better rate environment a year from now anyway. So a lot of people are looking at it and saying, well, again, getting into the cost of waiting, that we know the house price probably isn't going down. And if anything, it's going to go up. So if I can get that house at that 350 price point instead of getting it at the 375 or 400, then, I can always, it's a reverse take on the buy now and refinance later. You're buying now in cash and refinancing later.
So one of the hot topics, like really big thing that all the lenders were pushing back in December, late part of the year, was the 3-2-1 buy down. Are you still seeing that, or is that kind of faded off now?
It's certainly still something we're seeing some of. I think truthfully, there's not as many circumstances where I would say that the buyer is in total control like they were then. I think in a lot of cases, some of these scenarios are multiple offer, and we're getting, I saw an email just before I got here. It was, a revised offer, and the revised to the buyer paying title and shortening the contingencies and period and closing and upping the offer price. And, they try to be the first offer in, then all of a sudden there's multiple offers, and you're not able to get as competitive with some of those types of things. But we are seeing a lot of people still utilize a buy down to make most sense of it, because we're looking at when we're talking through.
Man, I've seen it on some of the listings I've had lately. I've seen a lot of FHA lately, a whole lot of FHA, and they're actually really good borrowers. And you probably go into that in a second about the programs, but I don't really mind it too much on the listings we have when somebody comes in, if they're a strong FHA buyer, offer maybe $5,000 or $6,000 over, and then the concessions back to buy down the rate to make it where they can get into the house.
Yeah, and I think that when you think about Fort Worth and the localized market that it is, if it was a lender that you trusted that called you and said, "Hey, Brady, these buyers, they can go conventional, but like they're going to save $200 to go FHA," and I can tell you confidently that we, from what we see on our side, and correct me if I'm wrong, if you see something, FHA appraisals just, there's a myth about them that is 10, 12, 15 years. Like, I think that all the issues people have always had with FHA appraisals are things that happened before we were in the business. Like, they
like a stigma that
it truly is. Like, it's just this thing that has just been carried on and on and on. And we had a situation a few weeks ago where it just, for the buyers, they were 680 credit, 5% down. I mean, they were a good borrower, but they were going to save $200 to go FHA. And we, kind of buyer, seller, us, we all got together and were like, "Hey, can we at least run it this way?" And appraisal hit, and it just, it was just a great option. So I think, to answer the question about the buy down options, I think they're still there. They're just less available because of the market getting a little bit more competitive.
Yeah. So let's talk about the different types of mortgages, right? If someone's coming to you, what are you looking at to determine the type of loan program you should put them in?
So,
and let's just put this, I guess, in the situation of a first-time home buyer, right?
Yeah. So we're gonna approach everyone with a blank slate, because at the end of the day, we like to look at it more of, we're an extension of a financial advisor for them, even though it's just their mortgage. We, in theory, can advise them on how much cash to use and how much debt to take out. And so that you can't take that lightly. When you think about, the goal is not to use all of someone's available cash. The goal is to get them into a payment that they're comfortable with as little cash as possible. So we're going to evaluate assets, we're going to evaluate credit, income, and we're going to really factor all those things combined with what they think that they want to spend and determine what makes the most sense across all the different loan products.
Yeah, you guys really kind of get a look behind the curtain, and see everything about what somebody has going on in their debts and income. So
yeah,
I guess you have to put the puzzle together, right?
Yeah, that's really what it is. I mean, it's problem solving, and that can just be figuring out the best scenario for someone, whether that's, I had someone just today who they're interested in an $800,000 house, but they're limited on cash, and they can't go 5% down because that doesn't get them to max conventional. So you're just looking at, well, what if we factor in a second lien, or what if we pull from other retirement assets to make it work, to still make it, be the most competitive offer, but put them in the best position long term.
Do you feel like there's more of that problem solving going on now than there were in the past 2 years, because all the appraisal waivers, everything else? Like, do you enjoy getting back to where you're actually having to really, I mean, you were doing it before, but with that waiver, when we're using it continuously, it's kind of like a locked in deal, right? Do you enjoy that piece of it, the puzzle? Yeah,
there's so much more, of a strategy to the market now than there was, because truthfully, there's refinances that were happening so often are relatively straightforward because it's someone that's qualified. You remove the stress of having moving trucks or anything like that, timelines, and then when things were so busy and you had these huge offers, like most of these people that had that amount of assets were all pretty well qualified or had the option. So now you're getting more creative to get more people qualified, and I mean, it's kind of the whole game of the business of figuring out how to put the puzzle pieces together. So yeah, that's always been one of my favorite parts.
One of the big topics that I think you and I've talked about that everybody's kind of been up in arms in, it's been all over the news about the low level price adjustments, where people with higher credit scores are paying higher fees on their mortgage than people with lower credit scores. So what is that, and how is that affecting people?
So there was a loan level pricing adjustment that was made, and in summary, it really impacted the way that the pricing matrix was impacted relative to credit scores and down payments and different things. And so it penalized some of the higher credit score borrowers and incentivized some of the lower credit score borrowers. And it didn't, people saw words like fees and costs and different things. And yes, it potentially got you a slightly worse rate in some identical scenarios prior. And it's not anything that we truthfully are happy about, but the actual impact is less apparent than people, the headlines make it out to be. A lot of these things, because, there was a big May 1 deadline or start date. And in theory, that's the date that lenders like us have to deliver loans by May 1st. So when you think about that, every mortgage company or bank had priced all this stuff in, really going back to as early as March and February. So it had been things that the mortgage industry were talking about constantly. But then, like a lot of things in our industry now, real estate and mortgages are pop culture because there's drama around them. And so it makes the news. Whereas, if you ask someone 10 years ago, what was your interest rate? Most people would be like, I don't know.
Yeah.
And now it's like kind of a badge of honor, or it makes, people upset. But I think on these loan level pricing adjustments, as the market improves, those adjustments improve with the market. Like it doesn't, if everyone has slightly better rates already, a month, 2 weeks into this, no one's really talking about it anymore. And there was
the news cycle's so fast. It's just funny how quickly something's so hot and then it goes away.
When we talked about it at y'all's team meeting, I remember one of the things I said was, truthfully, they had delayed part of the loan level pricing adjustment relative to debt to income ratio, because they were going to factor in that your rate was determined partially by your debt to income ratio, which truthfully is such a variable number, because sometimes, if you qualify someone and they make bonus, but you don't need to document the bonus, you don't use it. So
you just don't include it. Right?
Or like, let's say the underwriter underwrites the loan and they say, well, you used the bonus, but you can't actually, and the debt to income goes up. So now you're talking about the rates changing in real time through the loan. And that's what everyone was really pretty upset about. And they delayed that until August. And then just last week, they pretty much went away.
Scrapped it.
So that across the whole thing that happened, that was probably the biggest win, that piece of it isn't going to have to go into play.
So what are you seeing? I guess no one can predict the future, but what are your thoughts going into the remainder of this year of what you think is going to happen with the rest of the summer market and where rates are headed through 2023?
Truthfully, I think rates have reached their highest point. I think that the velocity with which they'll go down maybe isn't going to get everyone excited. Like people, I want to see them come down as fast as they went up. There's the big inflation report last week that everyone had circled on their calendar, and it was kind of a big bag of nothing once it happened. It was good news, but it didn't have that shock to the system and the market. So I think that, as inflation continues to go down, and as the CPI reports come out, I do believe that rates will follow it down. I just think that we're not going to see, the quick fix on interest rates.
I think 3s and 4s are gone for a long time.
I think so.
So, for you, where do you think a good, healthy mortgage market is? It is in the mid 5s, 6s. Where do you feel like that's a? When you and I started, I'm pretty sure they were around the 5s, 5.25, 5.5, and that is a pretty balanced market at that time.
So yeah, I would say, if you just look at what it felt like at 3 and what it felt like at 7, if you split that difference, I think the 5 to 5.5 is a really healthy place to be. The 4s I think are incredible, but that we were living in a little bit of a fairyland from a 100-year span of interest rates. 4s are really, really good.
Yeah.
I think people will adjust their mindset to thinking, we're used to these 6s and 7s. So if we can get in the 5s, and then what will be really interesting if rates do come down to there is if you can get a market rate at 5 or 5.5, you can buy that rate down into the 4s all of a sudden. And now you're buying it down to kind of a forever rate in theory, where unless, if that 3 and low 4 market doesn't come back, you can buy it down into the high, mid, or even low 4s, then you can, that buy down has longer lasting value because you truly are buying it down with the intention to stay there for a long time.
Yeah. I know whenever it was really low rates, we had people talking about buying down. It's I don't know why you would buy. That's such cheap money that you're borrowing off of, but some people did it. We had people, I remember, getting in the 2s.
Oh yeah. Yeah. I talked to someone just the other day who they need to move for work, right? Because we still in Fort Worth, we still have all these people that are relocating, and they bought the rate down to 2.25, and it's
you have a good rate.
It's a little different. So
that's going to be a shock to your payment going from a 2.25 to a high 6s, low 7s.
It'll be interesting too to see how many people become entrepreneurs, but in the sense of
being a landlord,
becoming landlords, because when you factor in what those mortgage payments are and what the the taxable value is, what the rate is. I mean, you're creating some of the best valued properties from an investment property standpoint. So
I mean, you're down at 2.25 on borrowed money. You'll never get that again. So one of the things that we talked about, right, the cost of waiting. So we talked to a lot of people that are worried about interest rates. They're worried about, I mean, it's something we've dealt with for the past year and a half, right?
Mm-hmm.
I want to wait till rates to go down. I want to wait till rates to go down. What is the true cost of waiting on your side of things? Like for us, obviously real estate continues to appreciate. But I'd be curious from a lender perspective, whenever we're talking to these people and they're worried about the rates going down, what advice would you give them about the cost of waiting?
Yeah. So let's go interactive example. So if a $500,000 house in Fort Worth today, let's say it's worth 500, listed for 500 today, new to the market. That house next summer, what do you think that house would be worth?
515, 520 probably.
Okay. So yeah, so I was going to say, so that's what, a 4 or 5% increase, which is still good, light in our market. So call it, let's say that it appreciates $20,000. So on that same, 500,000 with 20% down or 100,000 down, you would have a $400,000 loan. That the difference between 7% rate and 6% rate would be the difference of about $350 a month, or about roughly three and a half, $3,500 in total
Cost.
So you're saying that the savings of that is roughly $3,500. So the way we look at cost of waiting is you save $3,500 by waiting, but the net loss is $15,000 to $20,000 because you're buying a house for that much more
expensive.
So truthfully, to me, that just we know that houses and values in this area are only going to continue to appreciate, and that's at a that example is you're leaving $15,000 on the table, and that's at a 4 to 5% appreciation. I mean, what if it appreciates 10% and goes up to 550? Now all of a sudden you're trading $50,000 in appreciation for $4,000 in interest. In payment savings. I mean, so the numbers can be pretty drastic. So that's where you have to be able to obviously afford that payment today.
Yeah,
is the big piece. But if it's just uncomfortable or you don't like it, that's different than just flat out not being able to do it and choosing not to wait for prices to go down.
Well, and we saw it, even back when the market was the rates were so low, people were still waiting because they wanted to get a better rate, and they saw the rise of houses going up 25% year over year. I mean, you're talking about they can't afford the house that they're probably currently living in if they waited till today, because it's going to be the same price as the ones they were trying to buy.
Mm-hmm.
I love Dave Ramsey always talks about like the best time to buy a house was yesterday. That's one of the things he uses all the time on his show. And it's so true. I mean, sometimes, and I'm not encouraging people to stretch, but like when we bought our house, I was worried about like, oh, should we do this? And then it's worth a tremendous amount more than when I bought it. And we're in a much better position with our rates, things like that. So,
well, the other thing on that too is most people don't think about, depending on what stage you are in life, but I mean, especially as it pertains to first-time home buyers, because they're making the jump usually from rent to their first mortgage, but they're also so young in their career that they're basing it purely in their mindset of how much I make today, when they're months potentially away from promotions and years from taking a new job that makes a big pay raise. So they're thinking in terms of today, where there is an element in some cases of growing into a house, as long as again you're comfortable, can make that payment today, but it's not uncommon for people to kind of grow into that payment.
So people that are buying today, you had mentioned this before that you thought this would be good information for people to have, is about a recast. So can you kind of describe what a recast is and how it's beneficiary to someone that's taking out a mortgage today?
Yeah, so a recast is a really good tool for someone in this market because they know that they want to move, but the ability to time things perfectly is so difficult, because if you list your house, it's probably going to sell, and you just don't know if you're going to be able to find something, or if you find something and it falls through, then all of a sudden you're having to find somewhere else to live. But what a recast allows you to do is it almost works as an adjunct type of bridge loan, so to speak, because as long as you have enough cash or 5%, so to speak, to to buy the new house, and you can qualify from an income perspective to carry both mortgages, you're essentially buying the new home while retaining your current home with eventually the intent to sell it. Maybe, you have to do a little bit of work to that house, or you want to move, or whatever it is with kids. So then let's say you buy the house and then you sell your house and you net $200,000, and you want to go put it down on this $500,000 mortgage you've got. What a recast allows you to do is make a one-time principal payment. You keep the rate, you keep the term on that existing mortgage you got, but you're able to re-amortize the balance. So your payment adjusts for that money you make. Because otherwise, if you just go throw a little bit extra principal, your payment doesn't really change. So while it is good to pay that balance down, most people, they kind of want the instant gratification of the value.
Can anyone do that, or do you have to do something ahead of time before you go into the new mortgage?
So it is relative to the servicer that services the loan. All the servicers that we work with, as of today, have options for it. It's really common in the servicer market because, truthfully, they want, the goal as a servicer is to retain a mortgage and collect interest payments and mortgage payments. So it allows them to, have a greater likelihood that mortgage is going to stay for a longer period of time. So, it's so much cheaper than a refinance. It's, anywhere from $100 to $500, depending on who it is. And, maybe it takes a couple weeks or a month or something to get done just to go through the system. But it's, we've had, almost like one person do it a month. It's been a really common thing we've seen this beginning of this year. And, we support people throughout after the process to do it. And everyone's, had a great experience with it.
Okay. One thing I think, this kind of side note, but I get a lot of questions about what's the difference between like a mortgage lender and a mortgage broker. So are they the same thing?
So
like if someone's going direct to a Bank of America versus dealing with someone like what you got, what's the difference between?
So there's a few different layers of it. So truly a mortgage banker and a mortgage broker, a mortgage broker is going to essentially, for lack of a better word, broker the deal, get the loan, and then they're gonna take it to someone who isn't their company, truthfully, right? Like, so the difference between a mortgage banker, and that's what we are, is, I like to use the example that everyone that touches your loan from the day you go under contract till the day you fund has an email that ends with @legacymutual.com,
Mm-hmm.
right? All of our underwriters, all of our closers, our funders, the lock desk, everyone in pricing, the whole team, right? My team. Whereas when you get into the broker side, it's more of you're sending it to a mortgage house to underwrite it, and there's a little
going out.
There's a little less control, right? Like I've been on the banking side my whole career, and I'm a big, giving trust and reputation is really, really important to me. And I know there's probably a lot of great mortgage brokers out there, but I have always been fearful of, your mouth writing checks that you truthfully can't cash. Like, right? Like you don't know you don't have as much control over the underwriting process. You can't get exceptions as easily. Speed becomes a problem. So maybe in some cases, maybe the reason someone might go that route is say, well, the rate may be a little better in that scenario. But you lose some control in a process where you just want, everyone thinks everything's pretty easy about a mortgage until it doesn't go right. You just want to be able to have a little bit more control over it.
So what, just kind of advice for people who are starting the process, what are a few of the things that someone should look for when they are looking for a lender to work with? What are the important things that they need to consider going into that conversation?
So the biggest thing in this market right now, in my opinion, is we're all, as realtors, as lenders, managing fear in the market, because there's a lot of news out there. There's a lot of negative news out there. And there's just quite like a lot of fear. So I think for someone to, find someone they trust, I think local is so key in this market, just because so many things are trading so quickly.
I think people underestimate, I don't know if it's just Fort Worth, but this market around here, local is very important, especially on the lending side.
Yeah, Fort Worth, I mean, there's just so much about picking up the phone and what that listening is, you either familiar with your company, and there's just such a sensitivity, maybe not as much to the specific local person, but there's for sure a sensitivity to, well, no. This lender letter is from a big bank, or it's from a online lender that, like, we just, it's almost kind of got that contingent feel to it, right? It's like people don't like contingent offers because there's factors and there's variables that are out of their control. And when you get into a lender that you can't pick up the phone, kind of get a hold of them if you need to know what's going on, or at least have them update you on what's going on. People just get a little skittish on it.
I think the same thing applies right now for both mortgage bankers and for agents and brokers. Being a knowledge broker is probably the most important thing you can do right now for your clients, because as you were saying, the media, just the national media as a whole, shows the housing market and the mortgage market in a negative light because some areas are not doing well.
Right.
But that's why it's important to have somebody that knows what's happening here, because we have people come in from out of state. We've worked with a ton of people like that, but they think they can come in like offer way under, and it's different here. It's not across the board. And I think it's important for first-time home buyers or people getting into it to know it's not the same. The news is not always the same everywhere.
Yeah. Well, I think too, one thing kind of on the realtor and the lender side, when you think about what's important for someone looking to buy a house is, and I know you would feel the same way, like this, who your realtor is isn't truly, it's not a transactional relationship. It's similar with your lender. Like, I mean, you, as much as maybe more than anyone I've ever seen in this business, like create really, really good relationships and, become friends with a lot of the people we work with. And, but that carries through to all the different things that you ask your realtor for, movers and, serve, all sorts of different trades and plumbers and different things like that. Relationship carries so much more value than just like, hey, can you help me find a house? And hey, can you sell my house? And similarly with us, like we're, again, like I was saying earlier, we're really invested in like, what's the best use of your funds? How are we going to put you in the best position to succeed, accumulate wealth, and just kind of grow going forward. So I think that's a big piece too, is looking at it again with the knowledge base, but also just, as a part of your personal board of directors.
Yeah. And one of the things that's really important to me, I want to get people plugged in. So whenever somebody comes and works with me, I never know where they're at in their life, but not only do I want to find them like a great house, but I want to get them plugged in, especially if they're out of town, or get them plugged in with a good group of people, like people that they can trust, vendors. I mean, I think I just look at some of the different things I've done in the past, and when you provide value and it becomes more than just, like you said, a transaction, it makes and it's a big piece of continued business, right? So I don't know. I just like to have a lot of people around me, a lot of friends. So this is a great business for me to meet people and do that.
Yeah, no, I mean, I was telling someone earlier today that I talked to who they had some really unique professions, and I was telling him, I was like, one of the coolest parts about this business is the types of people you meet just organically through, the process. And again, I mean, we get to go through a lot of that personal information, but just the jobs and different ways people, build careers is really interesting, and getting to meet a lot of great people.
So let's kind of switch it up to the agent side of things, because I know you work with a lot of people around here local, and there's a lot of new agents that are struggling right now in this business because market changes. So what advice, the agents you're working with right now that are maybe more experienced, what are you telling them that they need to be doing to succeed in this type of market? And does that differ than what you would tell somebody that's new to the business?
Truthfully, I think it's the same in both cases, because I think COVID happened and the market kind of changed, and it changed, and it also got really busy. But I think sometimes people confuse that those two things were related.
Mm-hmm.
And a lot of the things that really worked well to build business before COVID in just a more healthier market that was unique, people got away from. And that's just the very basic things of picking up the phone to call people and meeting with people. So, right. So like you think about how, critical and big, accepting an offer on a house or making an offer on a house and understanding that, or locking in an interest rate. And, we're trying to take the approach of meeting everyone in person if we can, not like in Zoom, but in person. And you think about as an agent too, to, manage their fear, go through all the options and really meet in person, because, there's so much more value to that, to make sure that buyer feels comfortable, that seller feels comfortable. And then the other piece is just picking up the phone, right? Like if I met with a brand new realtor today and they asked me, what should I do to grow my business? It wouldn't be to like go start your social media account and like post 2 reels a day, or to go to like a young networking group or whatever. It would be to make a list of 50 people in your life or 100 people in your life that are in your quote unquote sphere, and call 5 of them a day, and call 5 people a day, and have 5 really good conversations. Make sure they know what you do. Invest in them. Understand what's going on with them, and don't even make it necessarily about business. Just interrelate with people and interact with people. And I think that if you had 25 good conversations a week and 100 good conversations a month, business will start to come.
I hope all my agents listen to this one.
Right? How simple is that, right? Make 5 calls a day.
I think it's hard for a lot of people to do that, but I think, you do coaching, I do coaching. And that's one of the first things I tell you is like, who are your potential clients? Like, go through and make a list of everybody you know and let them know what you do so you can become an authority and they see you in that light rather than maybe if you were doing something previously to start building your business. So, and I do agree at the past few years, a lot of agents, they didn't have to do the basics anymore. And it shows right now because you're having to work again. You're really having to consult people. Whereas before it was like, how fast can I get this offer in? How much are you willing to pay?
Yeah.
And that's all that mattered. Appraisal, comps didn't matter. I mean, it was like I talked to Matt the other day and he's like, that was the starting bid. The list price was starting bid. So I think,
it was a little bit of a wild, wild west. And yeah, I just think that you kind of get back to the basics.
I prefer this market much more.
Yeah.
I mean, not as high rates, but I like people to be able to have options and think about things for a brief second at least.
It's also it's a value addition market, right? Like you're going to work with a realtor that, you're probably having more situations where you're going on listing appointments and there's multiple people that they're interviewing, and you're having to truly make a presentation that shows that value. And we're talking to a lot of people that are speaking with multiple lenders, and so things like meeting them in person and getting to know them on a more personal level for what their true goals are. Those are just things you have to do in this market to be able to succeed. And it's not, there's going to probably be a lot of people by the year's end that don't stay around the market because, before there was kind of like the shake the money tree trick, and people would pick up the phone and the business plan was answer the phone.
Yep. There
wasn't like call. No, it was just answer.
Yeah.
So that's changed.
So do you have any last piece of advice or last words you want to share?
But no, as it pertains to any takeaways, I feel like we covered a lot of great stuff. It's just really, truly the basics, the value addition. I loved your piece about, that knowledge base, and just providing value. Because I think more so in this market than we've seen in the past, buyers, realtors, lenders, like the whole thing is value creation in addition to your clients to help everyone succeed at the highest level possible.
Well, awesome. William, thanks for coming back in and sharing a little update on what's going on in the mortgage market. Always enjoy it. If somebody wants to get a hold of you for more questions, how can they reach you?
They can call or text me at 903-571-1596. My email is william.adams@legacymutual.com, but either of those, easiest way to get me.
And he's always posting little reels now. Pretty good quick tip information. So it's a good follow on Instagram as well. William, thank you again. This was another episode of Real Talk with Reside Real Estate. If we can be a resource of any way, please reach out.